Hi, and welcome to our market update video for July 2026. So in today's update, we're going to run through a few different topics, including equity valuations, which have come off their highs, but do still remain elevated relative to long-run averages. We'll talk about lead economic indicators, which do look supportive for future earnings growth, both domestically and internationally. Interest rates and inflation remain a hot topic of debate. Interest rates here in Australia do look like they're near their peak, but they could be at those levels for some time because inflation still does remain above the RBA target band. In the US, rate cuts have been a key theme for some time, but it does look like higher rates are inevitable at some point in the US, given that the labor market over there remains very strong. I guess the good news on inflation, which we'll talk about further, is that oil prices have come off in recent months. So that's putting a little bit of money back into the pockets of consumers and taking a bit of pressure off headline inflation. From an asset class perspective, we do remain committed to fixed income as income yields remain very high relative to history, and fixed income also exhibits favorable characteristics with regards to capital protection and capital volatility. And within equities, we still remain positively disposed to sectors like technology, healthcare, and financials. So let's get into it. So firstly, let's kick off on share market returns over the last few months. So year to date, share markets around the world have delivered positive returns for the most part, although not in every market and not to the same magnitude in every market. Emerging markets in Japan have led the way by quite a margin. So both emerging markets are up 20% year to date, and Japan is up 10% year to date. The US and global equity markets in Europe are up between 5 and 10%, so mid-single digit range. And Australia is up, but a little bit less than that. The good news from a fundamental perspective is that most of the positive return that we've seen in share markets year to date has been driven by earnings per share growth, which is definitely a healthy characteristic. We haven't seen valuation multiples expand. On the contrary, they've actually come down a little bit, which is a welcome sign because, as we talked about previously, valuations are above long-term averages. So we do want to see earnings growth continue, which will help those valuation levels. And as I said, earnings per share growth has been pretty strong, in particular in Asia. And a lot of that has come from semiconductor demand as a result of the artificial intelligence trends going on and the data center build out that's going on. So companies in Korea and Taiwan have benefited greatly from that, and Asia and emerging markets have been key beneficiaries of that. Now let's look forward at economic indicators, interest rates, and our views on the share market going forward. So when we look at a range of different lead economic indicators, such as purchasing manager indices, such as new orders relative to inventories, we see that those indicators are moving up. And why is that important to us? Because those indicators are correlated and linked to future corporate earnings growth. So both the charts on the slide, you can see the correlations between those indicators and corporate earnings growth. And so whilst those indicators are moving up, that definitely does give us more comfort around future corporate earnings growth. On to the topic of interest rates, firstly here in Australia. So interest rates are nearing their peak. However, we do think that interest rates may ultimately stay at those levels for some time. So it'll be more of a tabletop scenario where it kind of just sits there. And the reason we think that is likely is because inflation still remains well above the RBA's target band of 2 to 3%. Currently, it's sitting at about 3.6%. So interest rates are going to be a little bit stubborn, we think, around that sort of the high 4% level. And ultimately, the future direction of interest rates will be guided by how sticky inflation is, which we think it probably will be a little bit sticky, and how the labour market evolves. And at the moment, the labour market is still pretty tight. Unemployment levels are still pretty low relative to history. So ultimately, we think that the RBA will keep tightening the screws and hold those rates around about 4.5% to 5% until inflation does come down, which will ultimately sow the seeds for the next rate cutting cycle, but that's not likely for at least a year in our view. Interest rates in the US have been moving up, or the expectations for interest rates in the US have been moving up over the last 6 months, both at the short end of the curve and the long end of the curve. And this is one of the big factors why the share market is starting to see a lot more volatility in it. So in the short term, we've had higher oil prices come and go, and that's moved short-term interest rate expectations higher. We've got similar dynamics in the labour market and the job market in the US to Australia, where labour market tightness persists. And so that does put short-term pressure, upward pressure on interest rate expectations. And at the long end of the curve, interest rates have been drifting higher. And a lot of the reason for that is that the US government, like many governments around the world, are spending more than they're bringing in through taxation revenue, and they're running deficits, and their debt levels continue to rise. So rising debt levels at the government level means that the service costs for that debt, or the required return from investors that are lending to the government, will go higher. So we've seen that shift both short end and long end of the curve. Ultimately, we think that that is going to continue, and we think that that's going to be in the background, and it just means that for equity investors, that volatility is likely to creep higher from where it is right now. For fixed income investors, rising long-term interest rates are a headwind for government bond prices, and those government bonds, we are relatively underweight in our portfolios. We prefer to invest in fixed income at the short end of the curve, which means that we'll continue to see higher fixed income yields for the shorter end of the curve. And so that's where we have a preference. An interesting statistic is that the future equity market returns in a rising interest rate environment vary depending on whether the rate rising cycle is sharp or moderate. So if we have a moderate or a gradual interest rate rising environment, future equity market returns sit at about 10% per annum, which is actually slightly above average for all market conditions. So if rate rises are gradual, it's not really so much of a problem for equity markets. The problem lies where you have rapid or sharp interest rate rises. And the story for equity markets in terms of future returns is that future returns are about -4% in a sharp or rapid interest rate rising environment. So that's not our expectation, but it's interesting that the divergence between a gradual and a sharp rate rising environment is quite stark for future equity market returns. Now, just very briefly looking at global equity valuations and growth expectations over the next three years. So what we observe is that the US share market, whilst expensive from a price earnings multiple perspective, actually doesn't look so bad when you factor in the earnings growth outlook. So the US earnings growth outlook is about 20% per annum over the next 12 months, which is well above average. The average earnings per share growth in the US sits at about 10%, so it's a lot higher than average right now. And a lot of that comes down to the fact that the US has got the largest components of the US has exposure to the AI trade. So all the capital investment that's going on by the big hyperscalers in the US are expected to continue to drive earnings per share growth over the next 12 to 24 to 36 months. When you look at markets like Australia, the earnings outlook is a lot more subdued, although it's still pretty good. So 10% earnings growth in Australia over the next 12 months, which to be fair, is higher than it was about 12 months ago. We were sitting at about 5% earnings per share growth. So the outlook for earnings in Australia has improved, and a lot of that has come from the mining sector and BHP in particular, and we'll talk a bit more about that shortly. Europe is another market that we quite like. It's a relatively mature market, but it's also a high quality market, and the industries and companies that make up that market are quite complementary to the US and Australia. It tends to be industrials, consumer, healthcare companies, not so much technology and not so much resources. So it does fit quite nicely between the US and Australia as far as sector diversification goes. One area that does give us pause is the investor sentiment levels. And the reason that we look at this is because when investors are greedy and exuberant and excited, future share market returns do tend to be lower in that environment. And what we do observe at the moment is that investor exuberance levels are at the same lofty heights as back in 2000, and also the highs that we saw in 2020, 2021, coming out of the COVID downturn, when governments were stimulating the economy and pumping cash into the market. So that is another data point that we're looking at that does give us some caution. So in the current level of exuberance that we see, future market returns historically have been negative 14.7%. So well below historical trends, which are normally about 10.5%. So that just gives us a bit of caution. I've already talked a fair bit about earnings and valuation, so I won't labor the point too much, but what we can see here is the orange line is the earnings per share for the S&P 500 in the US, and we can see that continues to trend higher, which is good for future share price expectations. And simultaneously, what we've seen is the green line, which is the PE ratio, the price earnings ratio. We've seen that moderate over the last sort of 6 to 9 months. So valuations have come off, and the reason they've come off is because the share market, the blue line, has kind of, yes, it's drifted higher, but it hasn't risen as much as the earnings. So that has meant that the market itself has actually gotten less expensive over time, which is certainly something that we welcome. And then in Australia, we've seen a very strong rally in the earnings outlook over the last 6 months, 7 months, and at the same time, we've seen the share market basically go sideways. There's been a lot of volatility in between, but net, the share market here in Australia has basically gone sideways. And so what that has meant is similar in the US, we've seen valuations come down. So valuations were pushing up towards 20 times PE back in late August last year, and currently valuations are sitting at about 17 times. So still above average, but lower than they were at their peak 9 months or so ago. And as I sort of touched on previously, the key driver for the earnings growth in the Australian market is the mining sector, or materials sector as it's known. And what we've seen over the last 9 months also is that materials earnings per share are up 60%, and a big driver for that is the fact that the largest component of that, BHP, has seen its earnings grow by 30% over that time frame. At the same time, we've seen financials actually go nowhere. So financials earnings per share has gone backwards by 2%, and really that comes down to the bank's earnings, which for the most part haven't really grown, and that's been a theme that we've called out over recent update videos that we've posted. CBA has done better than the banks and better than financials, and it's grown its earnings expectations by about 7% over that same time frame. So CBA, yes, it's a quality bank. We don't dispute that. And yes, it has done better in terms of earnings per share growth expectations than the sector, but it's certainly not been the key driver for the Australian market in terms of a fundamental earnings per share growth. It would be remiss of me not to talk about the budget impact on the economy and the share market. So let's get into it. So the recent capital gains tax and negative gearing changes that the government announced at their latest budget is certainly and unequivocally bad for housing and bad for bank earnings growth. Why? Well, there's a few points. Firstly, since the budget, Westpac has reported a 23% reduction in mortgage application volumes. So demand for loans, demand to invest in Australian housing has fallen off a cliff. Borrowing capacity simultaneously has also been reduced by 30%. We've seen house prices across the major capital cities declining. All of this is negative for credit growth in the economy. It's negative for the bank's earnings. And furthermore, the banks are still trading expensively relative to history. So there are a lot of reasons to be cautious on the banks, and it's not just because of the recent changes to the budget. The other point, which maybe is less known and less discussed, is the fact that these recent changes to capital gains tax actually makes dividends relatively more attractive to investors than capital growth. So why is that important? Well, what it does is it means that corporations are more likely to preference dividends over growth. So when they're sitting around their board tables talking about capital allocation decisions, they're more likely to defer growth at the benefit of paying out dividends to investors. Ultimately, this is going to hamstring corporate earnings growth in Australia and capital growth in Australia. So we've long talked about the merits of investing offshore for growth, and these recent budget changes just further entrench that view. Now let's get into Australia versus the US, and I've just taken a bit of an ode to the latest Football World Cup and Australia 0, US 1. So why do we preference global or US share markets for growth over Australia? Well, the first point is that historically it's been the case that the US and global equity returns have been a lot higher than Australian returns. Over the last 10 years or so, the US has grown by 327% from a capital growth perspective and dividend perspective combined, so total return. And Australian shares have grown by 152% over that same 10-year time frame, including dividends. So that's the evidence, that's the history. It doesn't mean it's going to persist forever, but that's certainly what we've seen. And the reason, or the key reason for that difference, has been that corporate earnings growth in the US has been a lot stronger than Australia. And part of that is the preference for dividend policy being greater in Australia. So companies are more willing to pay out dividends as opposed to reinvest for growth, and that does hamstring your corporate your corporate earnings growth potential going forward. And the other point is that innovation in the US is obviously a lot stronger than here in Australia. So reinvestment opportunities are more abundant, and that leads to greater earnings growth in the offshore markets like the US. And when we look under the hood at the actual stocks that make up the marketplaces that we're talking about here, in Australia, the largest companies are mature businesses, they're low growth, and they do have that dividend focus. Contrast with the US, where you do have a lot of innovative high growth companies, not just in technology, but also in consumer sectors, communication sectors as well, and others like healthcare and financials, where income growth is actually pretty strong. So that's sort of been the historical experience, and we really don't see much reason why that's going to change going forward. And the final point is that even though Australia is a dividend paying market, the relative dividend yield of Australia versus offshore markets like the US has actually slipped in recent years. So If we go back to 2021, Australian companies paid around about 2.5% more dividend yield than US companies, whereas now it's about 2%. So yeah, we think that for investors that are looking for dividends, sure, you're getting a better dividend here in Australia than offshore, but over time that advantage has actually become less advantageous over time. End of year financial sales. So let's dive into the US mega caps and software companies. So what we've observed over the last 6 months is that the US Magnificent Seven stocks, that is the largest technology companies in the world listed in the US, have actually traded a long way down. And currently they're trading at some of the lowest levels or lowest valuation levels that they have in many, many years. And I guess the obvious question is, well, why has that happened? And I'd say the key single reason is that investors are really starting to turn a little bit cautious around how much capital investment these large companies are making into data centers to support the AI build out that's going on. And over the last few years, these companies have funded that capital investment out of free cash flow, but they are now starting to dip into debt, which is not a problem as long as the returns on that investment that they're making in data centers and expanding their AI footprints is positive and is good. Now, the question about what level of return these companies are actually going to generate still does remain open-ended. And so what we think will probably happen over the next year or so is these companies will start to dial back some of that CapEx, or at least reduce the growth rate of the expansion of that capital investment. So if that was to happen, we think the market would see it as a prudent step. The other thing that they could demonstrate is what sort of returns they are generating on that capital investment. And if they can demonstrate that they're making, low double digit, mid double digit returns on that investment, we think that that would be very well received by the market as well. The final point I'd make on these big companies is that AI is a future growth driver. And they still have very large existing businesses that are generating significant amounts of capital or significant amounts of return on capital, which are really unrivaled. So they don't really have much competition in their respective marketplaces. So I think that's sort of our view on it. And because the valuations are so appealing, and because they do have such strong current established businesses, and they have the AI optionality, we think those three things position them really well. And if they can just adjust their capital investment and demonstrate return on investment from that, we think the market's going to, reward these companies, and that will be the catalyst for valuations to move higher from where they are right now. The other part of the market that's been sold off heavily are the software and related companies that are perceived to be AI losers, companies that are perceived that AI is going to be a very big competitor to their products and their services. And right now, these companies are being priced as though their earnings aren't really going to grow beyond the next couple of years. And so I guess the key question that we are sort of asking ourselves and trying to understand the answer to is that which of these companies will actually not only survive, but which companies will actually benefit in an AI first world? Which companies will adopt AI to complement their global networks, their relationships with global multinationals, to further entrench their services? And so there are a few that we do like, and we caveat this with we don't know yet for sure whether these types of companies are going to thrive going forward, but it's really a trade-off and a balance of probabilities. And the valuations for these companies now, for the most part, are very cheap in absolute terms and extremely cheap in relative terms, relative to the past. So companies like ServiceNow, which is down 56% from its highs, trades on a PEG multiple of just over 1x, and it's growing its earnings at 20% per annum. And this is a company that many people believe, and including the CEO of NVIDIA, will be central and integral in an AI first world, particularly around managing and orchestrating agentic workflows. Another one is Salesforce. It trades on a PE of 11x, still growing its earnings over 10% per annum. And Accenture is the third one that we think has a lot of potential, where it's providing consulting services to global businesses and providing knowledge workers effectively to help companies implement and grow their businesses using technology solutions, including AI. So those are a few names that we think are in the bargain bin. They do have a lot of potential upside. They do come with more risk than non-disrupted companies, but we think that their valuations do warrant some consideration in portfolios. All right, let's get into the portfolio implications. So in terms of portfolio implications for all of this and all these views, we do think that equities remain our long-term growth engine for portfolios, and that's supported by corporate earnings growth first and foremost. And there are a number of reasons why we think that's going to continue, and we've kind of gone through those. From a preference between international and Australia, for growth, we certainly lean on international for a host of reasons, including earnings growth, including dividend policy preferences, including innovation optionality. And then we've talked about some of those areas of within international equities that have traded down that we think have scope and potential for long-term growth-minded investors. Fixed income, we haven't talked too much about that in today's video, but we're still expecting sort of 6 to 9% per annum returns within fixed income, depending on what sort of fixed income sector and products we're talking about. And for the most part, those securities and those funds exhibit low capital volatility. So we think that's certainly a nice ballast within portfolios. And finally, asset allocation and portfolio rebalancing are really, really important tools for investors to take advantage of volatility, to take advantage of market dips, trimming the top off winners, adding to underperformers that we have a positive view on going forward. And we've seen time and time again that strategy does add quite a bit of value to portfolio returns over the long term. So thanks for your interest. Thanks for listening to today's video. If you do have any further questions, you can reach out to your advisor, and you can also find more information at our website. So thank you.